I'm here to give you a quick update on the secondary market. And I know we had a lot of discussion this morning about the different programs that the USDA has, NIRE, WIP, and CF. These are all lender-driven programs. And what motivates lenders to participate in the program is really the assurance that there is liquidity, that gives them the ability to recycle the capital and a level of profit. If there was no liquidity and if there was no profit, there wouldn't be any lenders. We would have these programs. So, the secondary market drives the interest of these programs, very much like what happened 80 years ago when Fannie and Freddie was started to create a secondary market in the residential mortgage business. And the minute they did that, it made it very easy for every American to, understand the dream of homeownership. Now, if you want to understand the markets, you really have to understand what drives liquidity and what drives the profit. And like any good mathematician would tell you, you always look at the second derivative because you need to understand the factors that influence the factors. So, who are participating in the secondary market? It's not a monolithic group. It's not one entity that participates. Raymond James is part of the secondary market, but so are broker dealers who deal with banks. We have end investors like USAF that's been in business since 1986. We have private investors that are coming in that have specific interests like the solar program or the REIT program. You've got funds that participate that are trying to put capital to work. You've got institutional investors like Pharma Mac that plays a very useful role, especially in the ag lending side, on FSA loans, long-term, long-hand, fixed-rate loans. You've got a lot of government institutions, like the Department of Transportation, if they're sitting on cash, they're required to invest in securities that are full faith, marketable, and secure. So you have that. Now, what I'm going to try to do is really take different data points that will help you understand the market and connect the dots so we can understand what's happening in the markets as a whole. So, because we have so many different participants, we've got a good depth in the secondary market that ensures the liquidity. So let's start with the profit element. Most lenders here in the room, they understand, that if the BDOs are not compensated, there's not going to be a whole lot of incentive to go, look for loans. Now, the yield, and I've done business with most lenders in this room at some point in time or the other, and you know very well that when you call me up asking me for a bid on a loan, the yield that you're showing on that particular piece of paper is looked at against the risk-free asset yield in the treasury market. And so there is a comparison, there's a benchmark, you look at where the treasury market is. That's where yield curve becomes extremely important to understand how profitability is determined in the secondary market. Now, yield curve has got different definitions. You can go around the table, and I'm sure there'll be more than one view on what yield curve is. If you want to understand the willingness of corporate America to make investments, you look at the difference between a 5-year treasury and a 30-year treasury. If you want to understand, what is traditionally considered as an indicator or a precursor of recession is really the yield curve, which is the 2 and 10 type of scenario. So 2-year treasury versus 10-year treasury. A year ago, the 10-year treasury was, if I recall correctly, a little over 3.25%. Today it is 1.75 or thereabouts, and it keeps changing. It may go down further if Trump makes another comment about not wanting to do a deal with China. The 2-year Treasury as well has gone from 2.8% to, I think it's 155, and I last looked at it a day ago. So what has happened is that the difference between the 2-year and the 10-year has gone down from roughly 50 basis points to 20 basis points. And I think in the slides that Raymond James circulated, it was 14 basis points. It's even lower than that, But it depends on the point in time. I'm taking today's yield, after the comments that Trump made in London. Now, if the 10-year Treasury is going down by 1.5% from 3.25 to 175, it's really an indicator that the prospects for economic growth are slowing. If the economy was poised to grow, the 10-year yield should be moving in the opposite direction. The fact that the 10-year yields are going down to 1.5% means somehow the market perception or expectation is that the growth is going to be slower in the years to come. Now, if you go back to September, the 10-year Treasury went down as low as 145 because there was a fear of recession at that time. These are all, snapshots, It's not that, on any given day, your 10-year Treasury goes down that there's a recession, but it's just the fear of recession that comes into the thinking of the psyche that you have. There may be others who look at, especially investors, the difference between a 90-day Treasury versus a 10-year Treasury. Now, if you were to use that as the benchmark, you might say that there was a little bit of inversion, in May, and it probably continued for a little while until the yields went up again in November. But it wasn't sustained, and the inversion was not long, and it was not deep to signal a recession. So you have that. Now, so no matter what measure you take, whether it's the 3-month versus 10-year, 5 years versus 30 years, 2 years versus 10 years, across the board we know that the yield curve is contracting, it's flat, and in some cases it could be inverting, once in a while. Now, when yields go down, investors look for better alternatives. And I think Raymond James put up a chart. I might add something to that chart, which is basically that about $14 billion, flowed into the muni market, which is basically debt that is issued or backed by charter schools, retirement communities, or companies that have the power to capture the taxes that states and cities might be levying. So you have, the flow of funds is periodic. When the yields go down, there's a rotation. When yields and treasuries go down, the rotation happens in the stock market. So, even the volatility in the stock market can be an indicator of a few things. For example, the volatility index, WIX, this last time I looked was very low. It was like 12 or something like that. But what does it mean? That means there is a lot of complacency. But complacency is usually followed up with reversals in a very harsh way, if you go back into the history of what things happen. So, the 10-year yield that we have in the U.S. is still 2% more than the 10-year yield on German bonds. So while we may be sitting here and be unhappy about the slow growth in the U.S., we are still the best house in a bad neighborhood. So we are still doing all right. Now, the other thing, of course, is that the U.S. is using interest rates as a way to value currency that Europe does not do. Now, what impacts the bond yields? We spoke about yield curve affecting, the profits for the lenders, because you're using that as a benchmark to compare the yields on the loans. Now, what impacts that yield? The second variable I was talking about. There are a variety of factors that impact the bond yields. You've got, at one level, there's inflation. At the other level, you try to understand the real economic growth, which of course is decelerating, quarter over quarter, and all the uncertainty that goes around with economic growth. So now let's take the factors to understand those three areas, just to get an overview of how the markets might be impacted. Inflation. And as I said, I would like to take a few data points so we can create a narrative around it. Now, if you take the 10-year Treasury, difference between 10-year Treasury yield and the 10-year Treasury inflation-protected security, TIPS, it's about 1.7%. And what that means is the market expectation is that the inflation over the next 10 years is going to be about 1.7%. Now, core inflation has never exceeded 2% since the mid-90s, other than times when commodity prices were very, very high. Again, there was a comment that was made about unemployment. I think it was Senator Rich that made the comment about unemployment being, at the lowest level in 50 years. But, people who, especially who understand the Phillips curve, really expect that when unemployment goes down, inflation should go up. But that's not happening. And if you think about it in a very commonsensical way, the Bureau of Labor Statistics is tracking unemployment, how many people are gainfully employed. But the wage increase comes when people switch jobs. People who switch jobs are the ones who actually make a little more money. And if you had the Bureau of Labor Statistics, for example, tracking, the rate at which jobs are being switched, we might get a better indication of what's really happening on wage inflation, I don't know, Senator Rich made the comment that wages are going up, but, I haven't seen the data, to back it up. So there are several factors that impact inflation. What's happening in China, the slowing the growth in China. You've got a population that's aging, there's globalization versus, reverse globalization that's going on today. And most importantly, technological advances. I'll give you an example. Since the 1970s, the most recurring catalyst for inflation has been oil prices. Now, in the last 10 years, something has happened. Technological advances have given us the ability to extract oil, gas from shale. And that has increased the supply, has suppressed the prices, and that's why, you find the inflation is not. So technological advances have got a lot to do with inflation as well, Now, if you look at the futures market, what are the futures market, what are the Fed telling us in general terms, The futures market telling us that there's a 50% chance of one rate cut in 2020. I don't know if it's right or wrong, but that's what they're telling us. We take different data points and try to create a narrative or understanding of the market. What is the Fed telling us? The Fed is telling us that unless there is persistent and significant inflation, I'm not going to increase rates. So what does that mean? If core inflation has never exceeded 2%, you've got to be at least at 2.25% core inflation for at least 6 months before they will consider, rate increases. That's what the Fed is saying. So most likely scenario is that, we are not going to see a whole lot of movement. Certainly, there's no impetus for reducing the rate or increasing the rate at the present time, for the foreseeable, at least for 2020. Let's look at the second factor, which is economic growth and how that impacts, the bond yields. The Purchasing Managers Index, which is really, the index that you use to measure activity, in the economy, really is around 51.9. Anything over 50 is, expansion, but 51 is hardly expansion. And it's really very muted compared to levels that we see during economic expansion. But what is happening is that the muted manufacturing activity is being offset in the United States by a very strong consumer spending or consumer sentiment. So that is one thing that is happening. But the consumers in the U.S. cannot save the rest of the world. So that's the reality. Secondly, you look at economic growth. We cannot have a talk about China. So the U.S. is a more self-contained economy, so we're kind of insulated in some ways. But the whole Chinese situation creates what we call as a cognitive dissonance, which is we have to hold two contradictory thoughts in our mind at the same time. In the short run, we're talking about cutting a deal and having a phase one deal. In the long run, we also have concerns about our dealings with China. But if you look at the sentiment here, we've got people who are national security hawks, who say that economy and military rivalry cannot be separated. You've got economic hawks that say that foreign firms are not being treated well in China. So you've got human rights hawks that say that the Chinese are very intolerant of democracy or dissent. So you've got all these constituencies that are against in the long term. That makes getting a deal done in the short term also more difficult, and I think that's what is playing out. Every few days we see a comment saying, "Oh, it's happening, it's not happening." It's just a reflection of the long-term concerns that people in the U.S. have about trade with China. Now, so 20 years ago, the mantra was, when Tom Friedman wrote the book, The World is Flat, the mantra was globalization. Today, with the new administration, it's just the reverse of globalization. It's everybody for themselves. Now, when you have a global economic system that is fractured, that means growth cannot be assured. There's no certainty of that. And we're seeing that play out because European growth is at hardly 1.2% this year. Japan is at 1%. The U.S. is at 2.3%. And everybody is trying to project slower growth for 2020. So you have that. Now, a slower economic growth means the 10-year Treasury yields could have a downward pressure. So we could see a 145 or 150, come into play. The short end of the curve is what the Fed impacts, with their activity. It looks like from everything we know that the Fed may not take any action on the short end of the curve, and if the long end of the curve, depresses, you could have a situation where, the yield curve could, shrink even more. Globally, again, the global growth, which impacts the U.S. growth, is expected to go down a little bit in 2020, from 3% this year to 2.9%, and with a very modest acceleration in 2021. So if you look at the investment climate, the investment climate is, in general, is being weakened by three things. One is there are uncertainties, with respect to what happens with our trade with China, with the UK departing, from the European Union, and a complete erosion of the global economic system or the rules-based system that you have. But the fact that you have the 10-year Treasury at 175, and you've got a 2% difference with the euro, it tells you that the growth patterns are diverging. So that's the general story. Now, typically, I started off with the comment that the yield curve is usually used, or a good precursor of what happens, with the economy going forward. Now, the yield curve has been flat, has been contracting, has been in the mild inversion, depending on how you look at it. But that's not the only indicator. You cannot take just one indicator of the yield curve and say, I'm going to predict a recession. There are other factors that come in. Usually, if there is a recession, the net interest margin at banks start compressing. Is that happening? I don't think so. The net interest margin at Bank of America, Wells Fargo, has been going up since October. Usually, if there's a recession, the credit quality at banks starts deteriorating. We have not seen any evidence of that either. So What is likely to happen in terms of growth? There's probably going to be a slowdown. We may avoid a recession, or if we have a recession, it will be a very short one or a shallow one. That seems to be the conclusion based on the different data points that I'm looking at here. Now, let's talk about liquidity. What impacts liquidity? For those of you who are paying attention to what happened in September, the repo rates and the rate at which banks borrow overnight from the Fed went up to 10%. Now, what is the reason for that? Now, the Fed uses 24 banks, and they are called as primary dealers, through which all transactions in the financial markets are routed with these 24 banks as exclusive counterparties. Now, the volatility in the repo market or the overnight market is happening because of the regulatory capital that these banks have to set aside. And this is a recurring event because banks are measured every quarter at the end of the year. So this is a dynamic that doesn't go away, the measurement of the capital against the assets. Now, how many of you have heard of the GSIB score? Anybody have heard of the GSIB score? Nothing complicated. It's a fancy way of saying global systemically important bank. That's what it is. And so there is actually a government entity that goes and calculates that score. And about 10 days ago, the GSIB score came out for banks. Chase Manhattan, for example, the GSIB score went up from 738 to 750. Now, what does that mean? That means Chase needs another $3.5 to $4 billion of capital, in order to justify the GSIB score that has gone up because they're more important globally, so from a global system standpoint. The second dynamic that's happening is the stigma that is associated with banks accessing the discount window of the Fed. That access to the discount window has really gone down from about $1.5 billion last year to only $750 million, by almost 50% this year. So when you take the two dynamics, the GSIB score and the stigma, the result is that banks have started hoarding cash, more cash than what they're regulatorily required to do. And when you do that, you're draining liquidity from the system and you're contributing to the cash shortfall, and that is what is causing the problems in the overnight lending market or the repo rates. That's to give you an example. Okay, Chase has at any point in time currently $120 billion in deposits with the Fed. These deposits with the Fed are called reserves. But that means $120 billion of liquidity, daily liquidity, has been taken out of the marketplace. Okay, so now Chase considers $60 billion as a safe level of reserves to have. So whether it's $60 billion or $120 billion, there's a lot of liquidity that's being taken out, and that's just one example, one of the 24 banks I'm talking about. So what did the Fed do? They started injecting money into the banking system through the open market operations, and they had to do it because they were caught off guard in September. What is to prevent the same thing from happening in December? It could happen. Nothing good can happen at a New Year's Eve party, if you take away the punch bowl. Think about it, So you have that. I want to briefly talk about LIBOR as an index. As most of you as lenders know, that LIBOR may not be or is not going to be available as an index starting 2021, I believe. Is that correct, George? 2021? Okay, so in another 2 years, we'll have LIBOR as an index. So what is going to replace LIBOR as an index? The 8 largest banks came together and they, about a year ago, they came up with an index called as SOFR, S-O-F-R, Structured Overnight Financing Rate. Nothing complicated. Now, to date, in the last year, there's only probably $200 billion, which is not really a whole lot of debt that has been issued using that as an index. So what it means is it hasn't gained acceptance, but there is no alternative either, that's in the marketplace today that could take its place, in 2021. I just wanted all of you to know that SOFR is on the cards. It could be a replacement, for LIBOR as an index, And I'm going to stop with one last comment about private equity. Companies that get involved in private equity. The mantra of private equity, really is to leverage up. And typically, the leverage buyouts, the amount of money they borrow is like 6 times EBITDA. That's a lot of leverage they put on, in all these acquisitions that they get involved in. And it's no surprise that the default rate for companies that have been backed by private equity is 2.5 times that of the companies that are public counterparts. So if you as a lender are involved in business acquisition loans, and behind that is a situation where a private equity firm has been involved, keep the default factor at the back of your mind. Now, with that said, I will close, and I'd be happy to take questions if you have any, or if there are specific things that you want to talk about in terms of structure, you can call me offline. So, yeah, go ahead.
Excuse me. What you said, what happens to net real interest rates to the mom and pop? For growth, is it stagflation? Is it inflation? Or
basically, the net real interest rate is zero, right? If you take off, the interest rate that's available in the marketplace minus inflation, because the real interest rates are pretty close to zero,
So that's stagflation.
Well, that is, we are in the borderline right now, so it's not at a stage where it's gone the other way around, but, they're not gone the way Europe has gone.
One other question, if you don't mind. What about the effect of this interest rate structure on the value of our U.S. dollar as it pertains to our balance of trade?
Well, the strength of the U.S. dollar, really, the strength of any currency comes from what they call as a purchasing power parity. So you look at, two countries, and you look at the differential in interest rates, and it's the differential in interest rates that drives, the value of the currency. That's really what's going on. And so, the dollar is very strong because the rates here are much higher. That's really, the bottom line. Now, at some point in time, ECB is still talking about easing. It's not like there's going to be any normalization there. And as long as you have, the U.S. interest rates still at 2% more than what you see in Europe or, EU, the dollar will still remain strong. That's the reality. Yeah.
So there's a lot of talk about negative interest rates in the U.S. now. Is that a real possibility?
There is talk about negative interest rates. There are people in the derivatives market. If you look at it, there are people betting on that. But that's like betting in Las Vegas. So I can't tell you that there's any. There are always hedge funds who take positions. There are huge hedge funds that go out and say the stock market is going down, so they take a huge short position. But in the derivatives market, I do see interest that indicate that some people in the marketplace think that there might be negative rates. Difficult for me to judge whether that's real or not. It's just maybe somebody speculating and trying to make some money, and it goes the other way. So that's the best answer I can give you. Any other question? All right. Well, thank you for your time.